Good morning, and thank you for doing this. If you can all come off mute and say hello. So what I'd get to do maybe is just sort of individually introduce yourselves. So if we, because they're in a particular order on my screen. Duncan, if you want to start?
Sure. My name's Duncan Ball. I'm the CEO of BBGI Global Infrastructure. We're a specialist infrastructure fund. We have 56 investments globally. We're in Australia, North America, Europe, the UK, and we invest in availability style infrastructure, core infrastructure.
Great. David?
Hi, morning everyone. My name's David Bird. I'm an investment director at Octopus Energy Generation, which is the fund management business within the Octopus Energy Group, managing around £7 billion worth of mostly renewable energy generation assets globally. And I'm one of the lead managers of Octopus Renewables Infrastructure Trust, which is our listed vehicle, which it has a focus on being diversified across wind and solar across Europe and potentially Australia, and also a particular focus on delivering additional return and value beyond just the income that comes from operating assets. So we particularly like to invest in sort of construction and pre-construction assets as well, as the operational ones that deliver the attractive dividends.
Oh, Georgina, I just saw you on mute before you start talking.
Thank you. Good morning, everyone. So I'm Georgina Britton. I'm a managing director at JP Morgan Asset Management. I've been there well over 25 years, and my specialty for a very long time, my focus is on UK mid and small caps. So I co-run several funds, including pan-European ones, but I'm just the UK portion. And in particular, we have one investment trust. We actually merged two investment trusts into one earlier this year. So the JP Morgan UK Smaller Companies Growth and Income Investment Trust, a snappy name now, and clearly, so that those cost disclosures, we're pretty excited about those two.
Great. And Neil?
Lastly, thanks, James. So good morning, everyone. And I'm Neil Herman. I'm a portfolio manager at Janus Henderson Global Investors. And prior to that, I was 22 years at Janus Henderson. Prior to that, I was at Morley Fund Management for 10 years, now Viva Investors. So 30 years experience in mid and small cap markets. And I'm the portfolio manager for Henderson Small Companies Investment Trust and the OIC as well.
Thank you very much, everybody. So I've got some questions, but obviously this is really about the audience so much as anything. So please do put your questions into the chat box on YouTube, and I will put them to this panel. Now I'm going to start off with this cost disclosure thing. So maybe Duncan first. Do you think it's actually affected your share register and your rating? And is this something you think will change now?
Yeah, I definitely think it's a great outcome to a problem that was hard to imagine how it came about, because it seemed like an own goal. It really seemed unnecessary, but it was creating a lot of confusion. We have a diversified share register, but we had a lot of multi-asset managers that were complaining that it was becoming harder and harder for them to invest and consider investment companies just because of the cost disclosure issues. We have one of the lowest ongoing charges in the sector. We're 90 basis points. But even then, it was still very challenging for them, because when their retail clients get their statements and they have the fund manager that's made the allocation to say BBGI, they're showing the 90 basis points that we have, and then they're showing their cost. And if they bought a traditional operating company as opposed to an investment company, the cost of management, the cost of running the business would not be separately disclosed. So it made it very difficult for us to compete against similar investment opportunities or infrastructure investment companies that didn't have the investment fund label. And so it was so I think the news yesterday was very well received, and I think it will change the landscape and allow a lot of people who had left the space to come back, or were considering leaving the space to stay longer.
David, do you find the same thing with your fund? That there are investors maybe that sold or that just refused to buy?
Yeah, very similar picture. It's always hard to know exactly how much was this issue. There's clearly been other things going on in the macro environment over the last couple of years, but certainly we'd heard from a lot of investors that this was causing them real pain. We've got just the same as Duncan described, where you can buy trading companies that are developing and operating renewable assets, ones that probably have a very different risk profile to us, doing a lot more sort of early stage development of massive offshore wind projects, which comes with a lot more risk. But fund managers are being sort of artificially skewed to maybe allocate capital there because they don't have to disclose all the costs that are still there. The management's there in the business, but they just don't have to disclose it. They can put a zero. So now we're at least on a level playing field, and people can make allocation decisions based on getting the right risk return profile rather than being driven by just an anomaly on costs. So yeah, I was we had our interim results out earlier this week, so I've been out talking to lots of investors, and there were a lot of very happy people yesterday on the basis of this news.
Great, good. It's definitely good news. Maybe we should move on, because I think obviously we're starting, the timing of this is like sort of off in that a lot's going to happen in the budget. Neil, is there anything that particularly you'd like to see in the budget?
Crikey. Look, I suppose let's standing back from the whole perspective, I suppose from you look at it from 2016, it's been political chaos in the UK. 8 years, 5 UK prime ministers, post Brexit, 2 of those PMs were unelected. So I suppose now we've got a degree of political stability in the UK, which is no bad thing. And clearly a government who's franchise on getting growth, and compare and contrast that with Europe, where you've got chaos in France and Germany and the US election. So look, I think the backdrop in terms of the Labour government is clearly a positive for the stability of the UK market. In terms of the upcoming budget, I mean, it's kind of rule 101 of new management team, isn't it? Really, let's put all the bad news out there ahead of the thing. Blame the previous guy or girl, or what happened, and then obviously set low expectations low. So clearly there's been a lot of doom and gloom in the press regarding potential, the state of public finances, and the requirement to raise taxes. And I suppose given their mandate said they're not going to raise VAT, income tax, national insurance, or corporation tax, they're not left with much, are they? So capital gains tax and inheritance tax very much in the in the shop window, with probably some change of the fiscal rules. So in some ways, we'd probably like as little interference as possible in the budget rather than anything positive. I mean, there's lots of things they can do from a market perspective, but certainly in terms of the fiscal perspective, I think we'd rather they did as little as possible rather than much as possible.
And Georgina, anything you're particularly worried about or looking forward to?
I think I concur totally with what Neil said. So I mean, I think what we'd be looking forward to is stability. That you start and you end with that, and we know that from much more importantly from our companies, that's what they're looking for, a stable background so that they can then get on and do their business and grow their businesses and employ more people and all that good stuff. Very clearly, I mean, as Neil said, a whole lot of suggestions have been made about what tax rises might come about or what might be abolished. And for us, UK smaller companies, so our benchmark is the NUMIS UK Smaller Companies plus AIM X Investment Trust Index. And clearly, there's been a lot of discussion about AIM. Our view on that, yes, it's out there. It is a risk. I know a lot of work has gone into providing information to the government about how important AIM is in terms of employment, growth, etc., all the good things that they're looking for. So we'll wait and see. I would just say from our perspective, of course we have AIM holdings and say it's a very significant part of our index. When we look at the share prices of what we own on AIM, believe you me, we don't think there's a premium in there for the benefits. So that's the way we look at it. And I can tell you, we own those companies simply because we really want to own those companies, not because they happen to be on AIM. So guess what? If there is sort of turmoil in the market, you can imagine that we won't be selling. We'll rather be looking to buy.
Yeah, fair enough. Good. So I think Duncan, a specific question here maybe for you here. So it's what guarantees would you need from the government to get you back investing in new hospitals, prisons, schools, that sort of thing? What sort of thing would you be looking for? And you're on mute.
Yeah, I mean, our our driver is we look at the macro themes, and we like stable, predictable cash flows that are coming from government counterparties, and we like inflation linkage. And we're very comfortable investing in the UK, but we also look to global markets as well with in well-established countries. What we look for is just well-observed rule of law, well-structured processes. And there's been a lot of discussion about the death of PFI in the UK but the overarching theme that we see is that governments around the world, whether the right of center or left of center, they see the economic benefits of investing in infrastructure. There's a well-documented multiplier effect that at every dollar in infrastructure results in about 1.5, 1.6 of GDP growth. So you get that multiplier effect. The other theme is that post-COVID, governments globally have large deficits and they need private funding. So we're very much sort of waiting for opportunities to work alongside the public sector, invest in critical infrastructure. And we're excited about some of the discussions that are coming out of the new government. Some projects that had stalled in the UK. There was the Lower Thames crossing was an example. Whether that comes back as it's probably not going to come back as a PFI, but there probably is going to be some level of private sector finance, and we see that as a theme. We have some lift buildings where local infrastructure finance trusts, where we see the importance of primary care in the UK, and the current government has said stressed the importance of investing in GPs and physicians to prevent them having to go to hospitals. So we're happy investing at all points of the spectrum, and it's really getting projects that are going to help communities and deliver stable returns for investors.
Thank you, Duncan. David, I mean, the latest auction round of subsidies for renewables was really quite successful, it looked to me. Do you think the government was overly generous and that's why we got so much done? Or do you think actually didn't go far enough?
I certainly don't think it's over generosity. So I think one of the things you saw last time around is an auction that really didn't go as well as it needed to. If you step back, and this is true not just of the UK, but right across Europe and globally, we need to build new renewable generation assets and all sorts of other things that go around them, like the wires, like storage. We need to build faster than we've ever built before. And so to have what we had last year, where the pace slowed in terms of new projects coming through, that's a problem for hitting our targets, not just on decarbonisation, but again on delivering the infrastructure that's going to make people's electricity bills cheaper in the long run, and that's going to give us energy independence and security, compared with what we had in 2022 when bills and access to gas became a real problem. So I think this latest round was already going to be a lot better, and then the new administration came in and said, actually, we're going to increase the limits, the budgets further, just to get more done. And I think that was completely the right thing to do. But if you look at the volume that's coming through from this auction, we still need to go faster than that. So there's definitely no sense in my mind that there's sort of been generous handouts. The quicker we can get this sort of infrastructure built, the quicker we get ourselves into the long-term system that's going to deliver cheap, clean power for everyone, and that will flow through to consumers. But yeah, I think what was really positive around that change and that increase in the budget is just the shift in tone and in sentiment, and I think that that gives the whole sort of developer ecosystem, and within ORIT we've got a couple of UK-based developers, one with wind, one with solar. There's a lot more positivity there about the UK specifically, and therefore more willingness to put capital at risk, trying to bring this next wave of projects through that can bid into auctions over the coming years.
Actually, Neil, Georgina, I mean, there's a lot of infrastructure stuff, hopefully they will build, but there's also a lot of house building to do. Are you investing in construction firms, building materials, those sorts of things? Neil, maybe first?
Yeah, look, I mean, absolutely. I mean, Labour have made a clear mandate in terms of building, and particularly in housing. So well, they've said they want to build 300,000 homes a year in the UK. We're currently building sub 150. Normalized output in the UK is probably 220, 240. So it's an ambitious target. And they've made it clear central plank of their policy, and they want to generate growth and tax receipts to justify having a second term. So absolutely, that's probably the kind of the clear beneficiary of the Labour government in terms of the UK economy and UK stock market. So absolutely, there's a significant opportunity in terms of building stocks, so house builders and building materials in particular. And yeah, we've got a number of investments in that space. So things like Bellway and Chris Nicholson and Genuit and Volution are all beneficiaries of that. So look, I mean, it's going to be a kind of a tall ask, and whether the supply chain is in place to actually get that level of output is going to be very tricky, because do we have the brickies and the sparkies and the kind of the plumbers to do that is a good question. But actually the ambition is a very positive, and I think it's a very good backdrop for that sector into the future.
Georgina?
I mean, I completely agree. I haven't got much to add, and we're very much exposed in this area. I think the one thing I would say, the issue for us as small and mid cap fund managers is that a lot of the house builders now are in the FTSE 100, and we just lost Redrow, because obviously that got bought very recently by Barratt. So that's kind of the struggle there. We'd love any new house builders to come and float, please. But again, I totally agree with Neil. I mean, actually, when we talk to our companies, the issue is going to be how on earth we get to that kind of number. Really, one of the key facets is going to be labour. The companies are very aware of it. They're trying, very hard on apprentice programs, this kind of stuff. But I think that is going to be the likely sticking problem on this.
Duncan, do you see the same kind of constraint?
Yeah. I mean, it's interesting that Neil and Georgina talk about house builders, but we look at it, the sort of first derivative, and say that population growth, they're saying it could be 1.5 million new homes in the UK over the next couple of years. Well, that translates into 300 new primary health centers. So you build new homes, you've got to build GP clinics for the people who are going to live in those homes. You're going to have schools where those people who live in those new homes are going to have to send their children to school. So it's the knock-on effect of the new construction. So we very much see that as a driver. Absolutely see the constraints in the labor market, and we talked about the D's being governments have deficits. It's the decarbonization that David talked about, that we're trying to get renewables in. It's demographics, it's the aging population. And then also in there is the digital aspect, making sure everything links up and can connect, and with data centers and the grid and all the interdependencies. So I think there's going to be a lot of infrastructure spending, but one of the D's that we also talk about is deglobalization and de-risking. We could see, we're seeing inflation coming under control, but there's certainly some harbingers in the future that could see inflation perk up again, especially if we go to global trade wars and tariffs and onshoring instead of what historically has contributed to reductions in inflation. So,
David, one of the constraints for getting renewables built has been the grid problems. So there just aren't the grid connections, and it takes forever to schedule these. Do you see the government actually changing that?
It's definitely an issue, and again, not specific to the UK. We see it across quite a range of markets. I think one of the things that perhaps has held the UK up more than some others is just the way the rules and regulations are set up, and some of the bureaucracy around what it takes to get approval for new sort of transmission infrastructure. So recently, I think there's been go ahead for a couple of big undersea cables are going to join sort of eastern Scotland down to further south. But those have been being talked about for almost as long as I can remember. And the sort of cost benefit analysis took years when it should have been obvious for a long time that we're just going to need them. So there's things that perhaps could be done to just speed that whole process up. Again, there's lots of, I guess, positive talk about that at the moment, and the whole sort of mission control setup that the government's put in with Chris Stark coming in to figure out how are we going to get everything connected. We need to get connected by 2030. Hopefully that will help. There's been some stuff going on in industry already. There was a letter earlier this week from the energy regulator around, again, doing more to speed that up. But I think it's fair to say that is the number one constraint for getting the renewables we need on up and running and delivering the cheap electricity to people is sorting that out. So there's work in progress on it, but more needs to be done to unblock that.
Yeah, and the other issue with that, there's obviously been batteries. So there's a question: Do you invest in batteries, and how do you feel about that sort of area of the market at the moment?
Yeah, so batteries is something that's within our mandate, within a sort of non-core bucket. We have up to 20%, and so far we have 0.04% in batteries, which gives you a clue as to sort of how we feel about it. So we've got an option to build a couple of batteries. I think one of the problems with batteries, particularly in this kind of vehicle structure, you look at the renewables investment trusts, and a huge part of the investor base has gone into them because they like the income, and they like the fact that the income is supported by really high quality fixed inflation linked revenues in many cases. So there's a lot of either government support schemes or offtakes with very high quality corporates. For example, we've got a 15-year offtake with Microsoft in Ireland, so clearly very good credit. So we've then seen these battery products come into the market, sort of offering a similar story in terms of maybe even higher income, but without the revenue certainty to support it. If you look at where batteries can make their money right now, it's very merchant. There really isn't much in the way of stable fixed revenue available for the long term. And that's what's caused the recent sort of problems in the sector, is that in 2022, when prices became very high and were very volatile because of everything that was been going on in Ukraine and the impact on global gas markets that had, batteries did incredibly well. And people started extrapolating that forward. Very clever independent consultants started extrapolating that forward. And then in 23 and 24, we've seen the story's been very different. So I think the batteries are definitely going to be a huge part of our energy system going forward. But there's still a lot of uncertainty as exactly what that revenue stream will look like, and therefore where is fair value for a battery asset right now. And I think people should expect that in a lot of cases batteries will make a huge amount of their return in 1 year in 10 kind of extreme events, and not therefore well suited to paying a sort of stable growing covered dividend. So perhaps there's a point around the structuring there, but we do like batteries in principle. We think owning batteries alongside generation provides quite an interesting long-term hedge around where different price and revenue dynamics go with those two sorts of assets. But at the moment, we don't see enough sort of return in them to justify the increased risk over the more sort of stable revenues coming from the generation assets.
Oh, fair enough. Neil, Duncan mentioned trade and sort of bringing stuff back, manufacturing back to UK and possible trade wars and things. Can you see this government interfering in trade terms at all? Is it that sort of a government, or will it just let things run?
I think, so if you like trade wars and tariffs, you're more worried about the US than the UK. I'm not sure our impact on the global economy is that significant. So whatever tariff we put on is probably not. So I don't really see that being a major influence at all, really. I suppose where we are concerned, where governments get kind of into the nitty gritty, I suppose where the risk lies is around labour regulation, living wage, employee protection on the cost side of our equation. I think the kind of the trade tariff thing is a global thing rather than a UK thing specifically. And I suppose that very much more depends on the US election than what's happened in the UK.
Actually, the specific question here with you, it must be, is it holding your fund, Mitchell and Butlers?
Yeah, it is actually. Yeah, no, exactly. No, and obviously I mean, to be honest, that's clearly one of the key components of their cost base is labour.
Mm-hmm.
And they've obviously seen significant inflation in labour in the last couple of years. Living wage has gone up, I think, 10% in the last 2 years. It's forecast to rise 6% this year. On the other side of the equation, there are offsets on other costs. So, for example, their food and drink inflation has come back to being now negative, and energy costs, which spiked, have now come again back to being negative. So actually, there's quite a lot of offsetting on the cost equation. The top line's actually doing pretty well. We're quite keen after COVID to go out and be social creatures again. So, you know, spending in pubs and restaurants is growing nicely. So actually their profitability is recovering very sharply from COVID lows.
Oh, Georgina, do you think the workforce is in a decent shape, or do you think there are things that the government can do to improve things in terms of training and getting people back to work?
Well, I was going to say, I think the workforce, as in those of us who are actually working, is in pretty good shape. I think the wage inflation is something we're all monitoring, and especially for companies like say like hospitality, where it's a very large part of it. But exactly, I was going to say that our issue in this country is not about the workers; it's about those who aren't working. And in particular, I think I'm not going to remember the stats, but you know, it's the 18 to 25-year-olds, the proportion that are doing nothing. They're not at university, they're not studying, they're not at apprenticeships. And I think I mean I understand that this is very, very high on the government's agenda, and it should be high on everyone's agenda. It's appalling. It's appalling, and it's appalling for them as well as, of course, for our economy. I think I would hope that this government spends a lot of time looking at apprenticeship schemes. I think there is, let's just say, room for vast improvement in those, and I think it's fantastic. I think it is very clear that it is, for a lot of kids, university is not the right route. Get out there, get working, learn on the job. You know, fantastic. So I'm really hoping to see some interesting stuff from the government on apprenticeships.
Cool. And if we stop and think about the market for a minute, because we talked a bit about digitization, there's been a lot of takeovers. I'm assuming Neil and Georgina, you've both been benefiting from those. Are you worried about the pace of the shrinkage of the market? Maybe Georgina, you want to take that first?
Absolutely. So I can say, luckily, this year, finally, we have had several bids in the portfolio. Last year, when again, there was a lot of M&A in the mid and small cap space, we had one. We actually had a good year, but we had one takeover. So we were getting a little bit annoyed. So I say we benefited from quite a few this year. Most importantly, at the right price. This is all about the price. You know, it's for some companies, you know, they need a much larger premium than others. But this is a question that I'm often asked, and in particular, because very clearly there are not many IPOs, almost none at all at the moment. I keep hearing about great pipelines, and I'm an optimist. I have to be an optimist in my job. So, you know, I do think, you know, you had Neil and I both done this for a very, very long time. IPOs, like everything else, come in cycles. The IPO market is not dead. It's absolutely not dead. When it is going to arise again, I can't tell you. We're all hoping it's 2025. But having said all that, so I've already mentioned, so for most of my funds, you know, my index is the NUMIS Smaller Companies Plus A. So that sort of goes well up into the 250 and then all the way down to, well, absolute tiddlers, which are too small for us to invest in. You know, we have absolutely no problem in finding areas where we want to invest money and finding companies we want to invest in. We have a permanent, you know, list of things that we're sort of working out what we could sell in order to find the money to fund those. So I can understand this from a big picture. If you look at, you know, the number of stocks that are quoted now, very clearly it's shrunk. But in terms of our opportunity set, we honestly can say it's not an issue.
Neil?
Georgina and I are agreeing a lot today. I mean, so literally, I mean, just like her, we've had a number of takeover offers in the last couple of years. There's an ongoing level of M&A in the UK market, principally driven by private equity and foreign corporates who see the value in the undervalued UK small and mid-cap market. I'd also say from a deregulation perspective, we're seeing a record level of buybacks as well. So I've never seen as many companies in my portfolio buying their own stock back. And that is a function of their balance sheets being in very good order. Leverage is very low over the cost of piece. And why would you go and buy something else when you buy your own shares at a kind of discount to the acquisition price? So there's two factors to the acquisition. There's the M&A plus the buybacks. I don't think it's healthy long term. I think fundamentally you do need a healthy IPO market to refresh the market. We saw that up to essentially 21, and then 22 and 23 and 24 have been incredibly quiet. Function of lack of confidence from investors, how markets have performed, kind of the fund flows from UK small cap investors. Like Georgina, we hear positive whisperings from investment bankers about how the IPO pipeline is full. And we've obviously had Raspberry Pi this year, which has done very well, which shows there's an appetite there if these things come and they're attractive and have long-term growth potential. So yeah, we think it would be, and I think it's cyclical, like Georgina. I think this fundamentally is about confidence. And when we see a pickup in the markets and flow improving, then I think IPOs will come back.
And do you think there are specific things that the government could do to encourage investors to invest in UK small cap, or should do rather than could do?
I mean, there's a whole suite of things that have been suggested for them to do. I mean, obviously, Georgina mentioned the issue about AIM at this point in time, and clearly there's the kind of the black cloud of potentially removing IHT relief, which will clearly be quite a bad day for AIM per se. I like Georgina, I agree that frankly AIM is now looking very cheap, has underperformed quite materially since the election was called. So it's a lot of this has already been factored into share prices, and actually in some ways could provide a fantastic buying opportunity. But the other things have been suggested. I mean, for example, we're all aware of the kind of the decline of ownership of UK assets by pension funds. Probably we're the most unpatriotic pension funds out there. We're underweight our own domestic market. And some mandate to see a minimum ownership of UK assets in pension funds would be incredibly supportive. It's a flow-driven market, and anything to improve the flows. I mean, obviously, we've clearly abandoned the British ISA, which was a pretty poorly thought-out concept anyway. But you could do things around minimum ownership of UK assets in an ISA or ownership by pension funds. So there's plenty of things they can do. The kind of the move on kind of cost side of mistrust is a positive first small step. Hopefully, it's a kind of harbinger of future initiatives by the government.
Actually, Duncan, do you see that there's something that the government could do in infrastructure where you co-invest in things with them as a way of changing the model to get things done?
Yeah, I think the model, we've seen derivatives of the model, in different jurisdictions. We've seen rebranding. The OFTOs have been successful. Those are effectively public-private partnerships, but with a different label. In Wales, they've introduced the mutual investment model, which is similar. They're using the LIP models for some of the primary healthcare, and the list goes on. So I think the theme is governments need the private sector's balance sheet and expertise sometimes too. I mean, they're transferring risk to the private sector to take on the risk of completing these things. Carillion was a great example of, while it was a massive failure of a large company, it showed that the system worked because a lot of the cost overruns were borne by the Carillion shareholders or their partners in these consortiums, and really there wasn't as much disruption to the government as would have been the case if they had developed these projects themselves. So I think there's a recognition globally that public sector, private sectors can work together for the right projects. Some projects aren't well suited for them. They're too small or too complex, but there's a sweet spot where governments and private sector can work well. And I think you'll see some different models emerge.
And David, I mean, in the renewables sector, we've already seen one of your competitors sort of do a tie-up with some UK pension funds. Is that something that you're exploring too?
So, so we can't give specifics about exactly what Orit's up to, but certainly, I think in a world where the investment trusts aren't raising new capital, then looking at ways that we can again continue what we've been doing over the last year of recycling out of operational assets, so that we can keep delivering growth. Obviously partnerships where there's a sort of a ready source of capital that wants to hold, but perhaps doesn't have the expertise to manage themselves. So maybe we can sell a minority stake to a more sort of passive financial institution. So there's definitely, I think, more that governments can do to make it easier for those kind of institutional investors to hold real assets, whether they be in sort of pension funds or sort of insurance assets. There are still blockers and limits on people being in to invest in these kind of assets or in the sorts of funds that hold them, whether they're investment trusts or otherwise. So yeah, it's definitely a sort of a category of capital that could do a lot more to bring renewables projects forwards, or to recycle capital to allow people like the investment trusts that have already put 20 odd billion, if not more, into UK renewables to keep doing that.
Actually, Georgina, in terms of like governments encouraging money to flow either from pension funds or off their own balance sheet into sort of funding new companies and doing something, is that a positive, or can it distort things and actually be a negative?
I think that's a good question. I think in part it depends how they encourage, but in general, given where the UK is now, given where valuations are now, basically anything that encourages money and should be good for the market, but also should be good for the investors. Yeah.
Cool, fair enough. Good. Right, let's get some sort of company specific ones, which might be slightly off topic, but they're probably still worth asking. So David first, I think. In terms of your, actually, I think this is relevant. In terms of your portfolio, is the UK a good place to invest at the moment relative to everything else you've got in Europe, or is it still, but they do have to still to do a lot more to get you to be allocating more money here?
Yeah, so we're not seeing the UK as either being sort of particularly weak or strong versus some of the other geographies where we're active. We're aiming to be diversified, and the UK is currently our largest market. We're comfortable with that. We're a sterling denominated product. It's our home market. It's where we've probably got the most experience. If we look at the attractiveness of the opportunities, it's there or thereabouts. Now, we also see interesting opportunities in markets like France and Germany, where there's still a lot of government support for new renewables, but equally there are other markets like some in the Nordics, which have got deeper and more established markets for selling power directly to corporates. I think where the UK probably is still a little bit behind is on that grid problem we talked about earlier. There's perhaps a longer queue and a longer bottleneck on the grid side still in the UK than in some of the other markets. And when we're wanting to do construction and deliver that extra return to investors, it just gets watered down if it's taking 4 or 5 years to connect a project rather than 1 or 2. So that would be the number one thing that could make the UK really sort of step forward in terms of attractiveness for new projects.
And Duncan, you've got a global portfolio too. Same question, really.
Yeah, I mean, we're sterling denominated product as well, so it's our home market in terms of how we report. We have 30% of our portfolio in the UK, and we're in Australia, Canada, the US, Norway, Netherlands, and Germany. So all AA and AAA rated countries. We're somewhat agnostic. We want to go to highly rated countries. We want to go to countries where there's a well-established rule of law, and where we know the markets and where we have people on the ground. We're a little different than a lot of the investment funds out there in that we're internally managed. So our mandate is all about making the portfolio better, not necessarily bigger. So we're comfortable growing, but we're not remunerated on growth in AUM. So we're not chasing the next big thing. So we don't need the huge growth in the UK. All we need is to be able to acquire a couple assets that are going to outperform in the next 15 or 20 years. So we're very much more selective on the individual project than trying to see a particular trend in any one market. So we look at a lot of transactions. In the latest reporting period, we said to investors that we've done analysis on over 50 opportunities. So we're while we haven't bought anything, we've been very diligent in looking at things, and we're just waiting for the right opportunities and we're comfortable buying back our shares if needed as well. So.
Neil, one of the things that people sort of say about the UK market is that we're very light on technology. Is that true? Is it just that we just don't have stuff that's listed? And actually, for you and Georgina, is there something more the government could do to encourage growth capital and just sort of keep things in the UK rather than going off to the States to look for money?
I mean, from a kind of general stock market perspective, absolutely. I suppose the UK is underweight tech versus the US, given the dominance of NASDAQ. Within the small mid-cap area, we've probably got a higher portion of tech than the FTSE 100. So FTSE 100 is dominated by banks, oils, farms, telcos. We've got a much more cyclical bias to the small cap. So tech is a decent portion of the small mid-cap and also of AIM as well, but also a much more pro-cyclical tilt. So I don't think per se that the small mid-cap world, in fact, is a very different sector exposure, large cap against small cap, and exactly much more cyclical in terms of the exposure. I mean, in terms of the kind of, if you're talking about stock market quoting, I mean, we're not seeing our companies head off to the States. And small and mid cap UK companies would be micro cap at best in the US, so they're not going to even register on the kind of on the scale. So we're not losing companies in that per se to the US, and I think exactly what government can do to encourage innovation and investment in the UK will be good. I mean, again, we'll wait and see what comes out of the budget, for example. But absolutely, if they can encourage investment in the UK economy, it's a good thing.
And Georgina, same question.
Sorry, Neil and I, we honestly haven't spoken for really quite a few years, even. I think it's last time since I saw him, but you can hear when we've got very, very similar views now. So definitely, I mean, again, clearly, FTSE 100 is very underweight tech. We do have a lot more. We also have some kind of companies that people don't think are tech, but really that's effectively what they are. From, I mean, say something like a train line. Well, that's a tech platform that gets you to buy your tickets online. Things like that. So I think it's much broader. Again, I completely agree with Neil. We're not seeing our companies, heading for sunny California or whatever it is, and they would be. I mean, they would be absolute minnows. They wouldn't even show on any radar. So that is not the threat. I think part of the issue, and a lot has been said and written about this, is that for profitable companies, which personally, that's what I invest in. They need to be making a profit already before we put money in. They're coming to market later, or they're accessing alternative forms of capital, and that's where I think again, a whole lot of potential initiatives, but that's where we need to make sure that the stock market itself is attractive. It's seen as and for a lot of our companies, and when we did have lots of floats, one of the questions we always ask is why are you floating? And sometimes it's very straightforward. They want capital and they see us as well, obviously permanent capital. But in addition to that, very, very frequently, if you're a services company, they talk about the fact that their customers will see this as a massive positive. Plus, indeed, all their infrastructure, their banks, everything. There is. I'm not going to say there was. There is, a real kudos to listing, and I think we that's kind of been a little bit buried recently, and I think we should be talking it up more. And then there are a lot of quoted companies who floated, let's say, over the last decade or so, that Neil and I will know, and they are very vocal on this, and they really, really have benefited. But I think we all need to shout louder on that score.
Oh, thank you. Would getting rid of stamp duty make a difference on shares, Neil?
Certainly wouldn't hurt, would it? Absolutely. I mean, it's certainly a cost for investors. 0.5%. It's not insubstantial. It would increase liquidity. I think it would help generally. I mean, I think it's highly unlikely we'll see a stamp duty removed from share trading. To be fair, I wouldn't have thought that's a likely first policy from the Labour government. But yeah, absolutely, it would help substantially. But I think it's highly unlikely.
Fair enough. Nothing radical. Okay. So I think maybe we sort of round up a bit now. So Duncan, can you sort of like give us the case about why you think infrastructure is well placed in the UK? And then actually there's a specific question you can sort of chuck in there. Will the US election have any effects on that at all? You're on mute. Sorry.
Sorry. I think what we offer investors that are looking at our shares are certainly currently is an attractive point of entry. So we're trading at an attractive dividend yield of 6.4% on today's share price. We've got a globally diversified portfolio. We've got a well-covered dividend at 1.47 times. We have good inflation linkage that is paid for by governments. So it's not dependent on consumers. It's not dependent on elasticity of demand. It's contractual. So if someone's looking for an income product that has been able to consistently return progressive dividends and seen the NAV grow over time, I think that's that's what we offer investors, and we do it by providing the kind of assets we all use every day: schools, hospitals, roads, civic infrastructure, things that are important to society. So I think that the opportunity set in the UK will continue to be attractive. But we're also diversified by market, so we're not dependent only on the UK. And your question about the US market, we have assets in the US. We would love to do more there. And so we're following that with interest. But again, it's one market out of 7 that we're in. So
fair enough. Thank you. David, same question, please. So what do you see the outlook for your fund?
Yeah, quite a similar story, I guess, with renewables in particular. It is the sort of trend that is not, it's a trend that's not going anywhere over the coming decades. There's just trillions and trillions of dollars of new investment needed, even just in Europe, where our mandate's focused to transition the economy to one that's not reliant on fossil fuels. And much like with Duncan, we view the share price currently as being in no way representative of where the value of the underlying assets is. We've proven that with asset sales at over net asset value, as have several of our peers. We've got other funds in our stable who are raising money in the private markets, who are willing to buy assets at the prices we're selling them at. So there's definitely value to be had. Similar story on the yield. We've increased in line with inflation our dividend for the past 3 years. The yield on today's share price is comfortably over 7%. So there's really sort of strong characteristics there in the portfolio, and lots of reasons for investors to be optimistic about the sector. And with rates continuing to come down, I really think there's a good chance of seeing that gap between share price and NAV closing over the coming months. So yeah, I think investors have got lots of reasons to be positive about the sector.
Thank you. And Georgina, are you optimistic?
Absolutely. So I think for us, I mean, there's so many things to say, but if you start with, I think we know a large reason why the UK and the UK market is very, very undervalued in our view, in my view. A part of that has been basically the narrative about the UK, the country, the economy, the inflation, etc. It's got completely out of kilter with the facts on the ground. I'm not sitting here saying that it's all great out there, and very clearly we've got some significant issues in our economy, but we're in no way the outlier that we obviously were with inflation. And in fact, we're growing better. Most of the data until today, sadly, the GfK data, which I think is all about the budget, I hope is all about the upcoming budget. That data is just getting better and better. And as I say, for us, that's what we look for in companies. And to be honest, that's what we look for in the economy. It's not shooting the lights out, but it doesn't have to. If expectations are so low and the facts are better, that is very, very positive. Then, as I say, I can't help it, I keep coming back to valuations, and as Neil touched on, the amount of M&A just confirms, we've been saying this for 18 months, 2 years, it just confirms our view on valuation, and the buybacks ditto. So and then the other thing I'll say, and we have actually been jumping up and down about the UK really for over a year now. We just thought that the valuation was so out of kilter with the facts on the ground, and what we were hearing from companies. Again, it's all about what's actually happening on the ground. But I can say, so I run a closed end, obviously, as I've discussed, but also open-ended funds. We have been seeing inflows for the last year. We are marketing our socks off. There are pitches going on. None of this means, the marketing and the pitches, doesn't mean the money's going to come, but people are seriously looking to re-enter the market again, the UK market. And we firmly believe that they should do.
Great, thank you. And Neil, do you think the government's going to be a positive influence or neutral or negative?
Look, I think in terms of, I've agreed with what Georgina said completely in terms of agreeing a lot today. I mean, in terms of the government impact, I think it's more about stability and providing a backdrop where we haven't got the kind of the chaos of the last 8 years behind us, really. So fundamentally that alone is positive for the UK. And then just the case for small cap, and to add to what Georgina said, I mean, I think, a couple of things. I mean, if you just look at the long-term returns from UK small cap, going back to 1955 when the Numis index was constructed, it's outperformed by 2.9% every year against large cap. Now, we know small caps are more volatile, less liquid, more prone to the economic cycle, but have been fantastic long-term investments. And we've gone through a really tricky period in UK small cap. I mean, I think the Numis underperformed, the mid cap underperformed the all share by 20% in 22. And you tend to get the best periods of performance in small mid cap after periods of dislocation like that. So you think about 2003 after the tech crash, 2009 after the GFC. This is when you get the best periods of performance from small caps. So in some ways, we're well set if the economy improves in 25 for really strong performance from mid and small caps.
Encouraging stuff. So thank you very much, everybody. It's been great actually to get sort of some views on this stuff. I'm trying to set things in my head. This is what's going to happen. So thanks everybody for helping out today, and we will be back next week talking to Warehouse REIT, but we've got a full lineup of guests going all the way through to the end of the year. Actually, the next one of these will be in November. But thank you very much for today, and for everybody that tuned in. Thanks for your questions, and we will see you again next week. Have a good weekend.
Thanks, James.
Thanks all.
Thank you.